3 ways whole life insurance lets you become your own bank. If you're new here, my name's Eddie Gardner, Epic Financial Strategies. And let's get into it right now. The 3 different ways that you can utilize whole life insurance. First, we're going to talk about financing your own debt, right? And so financing your own debt, what whole life does is it gives you the ability to take a loan from yourself to pay off debt and create customized amortization schedules that allows you flexibility and the recapture of lost opportunity costs. It also allows you to automatically increase your debt to income ratio. So 2 things that we're talking about here. First, the debt to income ratio. When you're leveraging life insurance, you're not creating this typical or traditional bill or debt, right? What you're doing is you're utilizing the cash value that's inside of it. You're paying off, let's say, a credit card. And by paying off that credit card, because that loan is from your own money with the life insurance company, that loan is not calculated in your debt to income ratio. So that's point number 1. You can improve your credit score by doing something just this simple, right? But next, you're utilizing your cash and allowing that cash to continue to grow. So what's really nice about this is you borrow that money inside the plan from the life insurance company, but the money that's there also continues to grow if you're using the right type of whole life insurance that has non-direct recognition in the dividend structure. So what that means is that when you leverage money from that plan, the life insurance company is giving you your full dividend and interest rate crediting, and that's important to the strategy. Let's get into an example right here. Buying a $25,000 car cash versus with cash value, right? So the point being, buying a car with $25,000 cash, you're no longer benefiting from that $25,000 in your world, meaning you don't have any growth on that $25,000, especially if you're buying a traditional or an average car that's going to depreciate in value over time, right? So you've paid for this car. You now have lost that cash. It's outside of your world. You just have the value of the car. And the second you drive it off the lot, it's going to be worth less than you paid for it. The debt or credit, right, if you're borrowing money to finance this car, is going to impact your credit. And then the interest that you're paying on that debt is going to go back to the creditors or the company that you're borrowing the money from. So not only are you losing the $25,000 that you're paying out over time, but you're also losing the interest on those dollars, all for an asset that is depreciating over time. But we all need vehicles, and so utilizing the $25,000 from your cash value, that allows you to still earn compounding interest on the money inside the policy. You can decide as your own bank how and when you pay that back, and the interest can be paid to your bank with positive arbitrage working in your favor. And let me just give you a little example of that, right? And hopefully they can put the numbers up on the screen here, but with $25,000 and borrowing at 7% for 48 months, essentially you would have a $589 car payment, right? So you go out, you finance a car, 25 grand, now you're gonna pay $589 a month, right? And that's at a 7% interest rate. The cost over the time of borrowing is about $3,735, which means in total for that $25,000 car, you will now spend $28,735. And that's the way most people purchase a car. Other people will purchase a car cash and then they lose any growth on that money, right? But what if you could do this? What if you use the cash value inside of your life insurance policy and that cash value continued to compound at just 5%? If that were to happen, that $25,000 over the same 4-year time period or 48 months would have grown at a 5% growth rate to $30,387, right? So this is significant because, yeah, that car is still worth nothing at the end of the term, right? You might be able to sell it for a couple $1,000. but you still have that 25,000 that was in your world growing over time, and it grew from 25,000 to 30,000. And so that's a big deal in just one transaction over a 4-year period. Think about that compounded over your lifetime. The second way to utilize life insurance in the Become Your Own Bank strategy would be from a retirement planning standpoint. You can utilize life insurance as a safety net because it's there to complement your traditional plans for retirement. Let's break this down, right? If you're looking at the slide here, 1 economic power strategy versus 2 economic power strategy. So you're asking, well, what is a 1 economic power strategy? That is what the majority of people that have done retirement planning to this point are doing. It's utilizing a 401k, an IRA, or market-based investments, right? So the challenge with a 1 economic power investment-only strategy is while you're climbing that hill, right, climbing that mountain of retirement, the only thing that you really care about is what is the average rate of return. And so this is where you'll hear most financial advisors and people that are worried about assets talk about the rate of return that their portfolio gets. You spend your life chasing that rate of return to get the best rate of return, and that average is all that matters. Well, okay, when you get to retirement on a 1 economic power strategy, average is not the only thing that matters, and we'll speak on that in just a bit. The actual return, when you get to that planned distribution, that's what matters, right? And so the challenge that people face is once they've gotten to retirement, they're not going to be able to predict what the stock market does. So that idea of, hey, I averaged 10% over the last 30 years, wonderful. But year to year, are you getting 10%? The answer is no. Some years you're going to be down 20%. Some years you might be up 20%. And the problem is when you're in that distribution phase and you're looking to take money out, if the market drops 20% and you've now pulled money out of that, you've locked in those losses on those dollars, and your portfolio has to perform at about a 25% return the next year plus just to get back to where you were. So this is the challenge people face, and they don't even know that it's going to be a challenge because nobody is talking to them about this. This is why retirement is a real crisis here in America, and it's why so many people are relying on Social Security system just to fund their retirement, and this is a real challenge. Lastly, to safely sustain a portfolio for 30 years, you may have heard of what's called the 4% rule. The 4% rule is something that goes back to a paper written by Bill Bangan in the mid-90s. And what Bill Bangan talked about was his study of portfolios and economic climates and looking at a diversification, and all of those years, different year strategies, the only ones that didn't fail are portfolios that took out less than 4%. Any that were over that 4% amount failed. And failure in retirement means that you have no money left. And that is really the challenge that most people face. So where the second economic power strategy comes in is using what we'll term as actuarial science, right? The way that you understand actuarial science today is if you look at life insurance, which is a product that is created by actuaries, right, in these insurance companies, and they understand the risk and the longevity of people. So looking at actuarial science, the other way that you would understand it is in your traditional pension plans, right? Most people in the past had a pension that would pay them out for a certain period of time. Now, I'm not talking about a government pension that is rated by politicians and is underfunded. I'm talking about companies that had fully funded pensions that guaranteed a paycheck for their workers at the end of that period of time, right? And that guaranteed income always coming in was a substantial part of their retirement and really allowed them to retire much more comfortably. So if you're thinking about those two points of actuarial science, well, let's get into some more and how you can utilize this in your own world. So think about this, right? you have a life insurance policy that you've been funding over time and it has cash value built up in it. And you may have utilized it in that accumulation period, but maybe you didn't, right? It doesn't matter. But as long as the money got back into that plan and you have this pile of cash value when you retire and you have these investment assets over here, what you can start to do is play the market, right? Because the cash value in a whole life insurance policy is not correlated to the stock market. And that means when the stock market goes down, the cash value in your whole life insurance policy does not, right? And so think about that same scenario that we were talking about earlier, where you've retired, the market has dropped 20%, but you need to pull from a portfolio to now cover your living expenses. Well, what you could do is in the years that the market's down, pull from your whole life insurance, utilize that cash value, which you can utilize income tax free, take the money from there. This way your assets can go back up, right? The market can recover because the market's not going to stay down, 3, 4, 5 years in a row. Likely the markets will rebound over time, and that's what we traditionally see, right? We'll have a bad year and then the markets start to climb back up. So by allowing your portfolio to grow back to where it was, it allows you to create a more sustainable and higher rate that you can draw each and every year, so you don't have to live under just that 4% rule. So again, look, I'm not saying don't invest in a 401k or an IRA. In fact, what I'm really saying is if you're looking to do retirement planning, you want both. You want market-based assets and you want this actuarial science piece of life insurance cash value, because those two in combination will help you get a higher, more efficient income stream in retirement. And a third way to utilize whole life insurance in that become your own bank strategy would be paying for college. So let's think about this. Paying for college with whole life insurance helps you create a flexible repayment plan. It allows you to gain more favorable interest rates, and it has the ability to use the tool of life insurance for more than just educational expenses. So this is something to think about as a parent. And you can do this a couple different ways, right? You can have a whole life insurance policy on yourself and utilize the cash value in that to maybe fund your child's education, right? Or you can create a life insurance policy for your child and fund that, and utilize the dollars inside of their own life insurance policy to fund college. But the dollars aren't single use. So 529 plans are a single use vehicle, right? The whole strategy is for higher education expenses. And it becomes difficult to get the money out of the plan if you're not using it for higher education expenses, because you'll be subject to taxes and penalties if you don't, right? Now, there are some ways to transfer to other beneficiaries in a 529, right? But the point of it is it's a single-use vehicle, and it has many challenges associated with it. Number one that I can think of off the bat is in 2008, when the market collapsed, how many parents had kids going into college that year, and I've spoken to a few of them, had kids going into college, thought that they had college completely funded, and because of the market collapse, they didn't get to fund all the years of college from their 529 plan. So think about that as you're looking at ways to fund college. So by utilizing the money inside the life insurance plan, it allows for two things. And the way you could structure this, and this is just one of many ways, is you could have the child take a loan for college. If you have them take a loan, this now gives them skin in the game, right? Have those payments deferred. And then when the child graduates, if they meet your criteria, not just graduation, but maybe you wanted them to keep a certain GPA, maybe you wanted them to reach certain milestones, you set those terms. And you say, look, if you can do X, Y, and Z, when you graduate from college and you've hit those milestones, we'll pay for your college, and we have the cash here set aside for it. Here's the other thing. You may have a child that academically is smart or athletically is gifted, and they're able to gain a scholarship to college. Maybe they could even gain a full ride, right? And if that happens, well, you have money set aside in this plan that can be used for other things, right? So it could be used for them to purchase their first home, to make other investments and utilize the banking strategy for themselves, or it can accumulate over time and get to retirement, and you'd be surprised just what a head start on retirement you could create for a child by putting small money into a plan today and letting it grow for the next 20, 30, 40 years. If you feel there was good value in this, please give it a like, share to people you know in your life that would need this same kind of information. And if you're looking to take a deeper dive into whole life insurance and really understanding the infinite banking strategy, go in the description box below, fill out your information. There's a link in there. We will give you access completely free to a virtual training that has been done. It's going to go into a lot more depth and detail on just how to utilize the life insurance strategy, how to get qualified for it, and also if you're already ready, right? You've figured it out, you know that this is for you, and you want to speak to a member of the team, there'll be a link in there as well. Click that, fill out your information, and a member of the team will reach out to you and really get to know and understand your values, what you're looking to accomplish, and help design the right policy for you.